Good afternoon, everyone. Once again, welcome to each one of you on this Team Casa platform. And today's topic is international taxation. And we have Singhal sir. स्वागत है आपका.
Thank you, sir.
Welcome to you on this. Today's topic is concerned. First session will be taken up by Anshul ji, and the topic is key tax consideration in cross-border transactions. And second session will be taken up by CA Sudha ji from Mumbai, entry strategy in India. So basically, we are going to cover the entire cross-border transactions and entry strategy and various tax matters in this. And first time we have with us Anshul ji on this platform. So I would like to brief about him as he is expert in various. Anshul ji is a partner in Lalit Vinjani and Company, practicing in Gurugram, Haryana. He has more than 15 years of experience with him in corporate tax, transfer pricing matters, and has worked with Big Four firms around 13 years. Anshul ji has believed in technical thoroughness and assist various multinational clients in tax planning, compliances, tax controversy, and various other matters. He has undertaken various tax health check assignment and regulatory advice client on the best compliance practices. Anshulji is also well versed in foreign exchange regulations in India and assists client in advising on the efficient mode of investing repatriate strategies. By profession, he is honored graduate in commerce from Delhi University, member of our prestigious Institute of Chartered Accountant of India, and regular speaker in seminar organized by various branches of the institute in various forums like NIRC, ICI, in study circles and branches. So well-known speaker in everywhere around the nation. So once again, welcome to you, Anshulji, in this forum. Uh, and to all participants, we are covering first the technical session 1 hour, and thereafter, if you have any query, then we will take up for discussion. So you can post your query in the chat box. And now I request Anshulji to take up the first technical session. Over to you, sir.
Thank you, Sumit. Thank you for inviting me and allowing me to share my thoughts with the viewers of CASA. And it's a wonderful initiative which you have taken and organizing such wonderful seminars and webinars for the profession and members. It's really commendable. So today we will be discussing about the international transactions and what are the key considerations which we should be taking care of while entering into some cross-border transactions. So I would like to share my presentation with the viewers. Just allow me. And please feel free to put some questions around. Let's make it interactive. And if you have any query in between, I would be happy to answer those queries. So let's move forward. So what we will be discussing today is what we face in international transactions and what are the general kind of international transaction, cross-border transactions is, first of all, and the foremost is the individual taxation. We have seen globalization in last 20 years and there is a lot of inflow of expatriates as well as outflow of expatriates from India, right? So how should we deal about those taxation of those individual employees, and what are the key considerations we should keep in mind while filing their tax returns in India? So that we will discuss. Second is, while we are making payments to foreign vendors, foreign service providers, or foreign products sellers, whenever we are doing those payments, there is a lot of taxation implication which arises on those transactions. So we'll discuss what are the key considerations around that. We'll also see that nowadays what is happening is a lot of companies and a lot of entities are going outside of India and making investments there. Even if they are not making investments, they are earning revenues from foreign clients. So when they are earning revenues from foreign clients, what should be the considerations and what should be the implications we should keep in mind while filing our tax returns and while calculating the income tax computation? And the last is the capital contributions. So we will also discuss that even though we are in taking capital contribution or a share capital from foreign shareholders, there also there can be some tax requirements and tax implications. So we must be careful, and we must be, aware about what we should look for and where we should be keeping an eye. Now, moving on to first topic, which is individual taxation, you would see that we will first cover outbound expatriates, means the employees who are going out of India for employment purposes, and then we will cover inbound expatriates, where the foreign expatriates come to India for employment. So first of all, the very primary thing about international taxation is that we should determine the tax residency of the expatriate employee very, very carefully. We should be very careful in understanding the tax requirements, the domestic tax laws, what are the applicability there, and how is it going to be affecting the tax liabilities in India. So say for example, if a person has gone outside of India for a short term duration, so whether the person has become a tax non-resident in India or not. If a person has gone outside of India for taking a full time employment, then you must see section 6, wherein the time limit is saying that if you have gone outside of India for taking up employment, then 60 days should have expired, and whether the 60 days period will now be converted into 120 days as per the recent amendment in the Income Tax Act by Finance Act 2020. So we should be careful. Why should we be careful is because when the person has gone outside of India, so the income which is being earned outside India from this employment services rendered there, whether that income will become taxable in India or not. So this is a very, very crucial and critical point of critical important issue, which we must take care while filing the return of that particular employee. Now, say for example, if the person has become a non-resident, then whatever income that fellow has earned from the services rendered outside India should not be taxable. Now, what happens is that the companies many a time keep on paying the salaries in India. Say for example, if the deputation is, say for example, 1 year or 2 year, where the family is still putting up in India and the bank account is also maintained in India, part of salary keeps on getting remitted to the Indian bank account only. And in that particular situation, the Indian companies are in a dilemma whether to withhold tax on that salary or not. In that case, one should be very careful about the residency situation. And if a person is considered to be a resident outside of India, the companies can take a position that the income, even if remitted to the Indian bank accounts, is not taxable, and therefore there is no TDS requirement. Now, this can help in saving a lot of working capital for the employee, and also help in making a right claim in the income tax return. Now, what should be the employee's responsibilities, or what should the companies do in order to determine these positions? They should go and approach the foreign tax authorities wherever their employees are deputed and ask for the tax residency certificate of their employees, or the employee can himself approach the tax authorities and see whether he becomes a resident in that particular country or not. So once a tax residency certificate is obtained, it will make sure that you are able to avail the treaty benefits. Because why I'm saying so, in the Indian Income Tax Act, even for a non-resident person, if the income is received in India, that income is treated as taxable in the hands of the non-resident. However, there are many case laws which say that the non-resident, if he is a resident of a country where the treaty benefit is available, they can take recourse to the treaty benefit and say that even if the income is received in India, that is immaterial, because as per the treaty, employment services are taxable only in a country where the employment is being rendered. So therefore, we must keep in mind all these things while planning the taxation of an outbound expatriate. Now, say for example, the person has not become a non-resident in India, and the person was outside of India for a short period of time, say for example 4 months or 6 months, and the person keeps on holding his residential status in India as an ordinarily resident. Now, what will happen in ordinarily resident person's case is that the entire global income will be taxable in India. Now, when the entire global income is taxable, what will happen is that wherever the services have been rendered, the country, the host country, we say, wherever the person has gone and rendered the services, the host country will say that now you have rendered the services in India, we will also tax it. In that case, there is a kind of double taxation. To avoid double taxation, the treaties as well as certain provisions of Income Tax Act says that the in person can take a credit, a credit of the taxes paid in the foreign country. Now, for claiming that tax credit, there are certain conditions. First of all, you must file a Form 67. So Form 67 is very important to be filed. Until and unless you file a Form 67, the foreign tax credit will not be allowed by the income tax authority. And many people do not know this and they forgot to file Form 67. So this is one thing. Second thing is that you must obtain the proofs of tax payment in the foreign country, either the withholding tax certificate issued by the local entity there in the foreign country, or if you have filed a return of income in the in that jurisdiction, that can also be kept in, and wherever it is required by the income tax authorities, it might be required to be produced as an evidence of paying the taxes, right? So this is something which must be kept as backup documents in order to claim the foreign tax credit. Also, another important point which comes to mind is that whenever a person is coming back, say for example, if the person was on a long-term assignment outside of India, say for example 4 years or 5 years, and the person is planning to come back, it is good to plan the time of coming back, right? Because if you are coming in the middle of the year, there is a possibility that if you have not been long outside of India, if you were outside of India, say for example for 2 years or 1 year only, then during the year in which you are returning back, you will become a ordinarily resident, because there are conditions. You would remember that 365 days in 7 years, or 9 out of 10 years you are resident in India, and you have spent more than 60 days in India or more than 120 days in India, then you will become resident. So all these conditions must be considered so as to plan your return back to India. Most of the times we say that if you can, then plan to come back in February, because when you come back in February, you have spent less than 60 days and there is no possibility that you will become a ordinarily resident in India. So therefore, if you are planning to come in January, it can be planned in February. So it can help you in saving a lot of taxes. Why I am saying so? Because when you become an ordinarily resident, your global income become taxable. So if you are coming from a low tax jurisdiction back to India, your income which you earned outside of India will become taxable. And even if you have not paid taxes, you will be required to pay tax in India. So this is something which can be considered, which should be kept in mind. The other thing is when the person is outside of India also and inside of India also for the part of the year, then there may be a situation where you have become resident of the foreign country as well, and you remain a resident in the Indian country, India as well. In those circumstances, you should know whether the tiebreaker rules apply or not in the treaty, and if the tiebreaker rules are applicable, for which country you are becoming a resident. Now, it may happen that all of the tiebreaker rules may apply for certain period of time for one country and for the certain other period of time to India. In those circumstances, there is a concept of split residency. Now, this concept of split residency you will not find anywhere in the Act or in the treaty. This is something which is a judicial concept which has been propounded in some judicial precedents. Say, for example, in one of the cases which I have mentioned here, Raman Chopra versus DCIT, it is a Delhi tribunal case. In this case, the person was in US till July of a financial year, and after July, the person came back to India. Now, the tribunal held that for the period of April to July, the person should be considered as resident in US, and from August to March, the person should be considered as resident in India. So they split the financial year into two. They didn't consider the residency over an entire period of year. So that is something which is very interesting, and one should be aware about these concepts while dealing with international transaction, and they can be handy. And we have one appeal by using these case laws also. So this is something which is important to know. and important to use in practical circumstances also. Now, one other thing, very important aspect is that when a person is going outside of India, they may open up a bank account in foreign country. Also, they may be issued certain ESOPs outside of India. They may have some investments outside of India. Now, when the person has come back to India, they keep on holding these things, these investments, these bank accounts for a certain period of time. Now, invariably, people miss out that these are foreign assets and must be disclosed in their income tax returns. So this is very, very crucial because black money law is very stringent as on date. And if you have any kind of foreign assets and you have become ordinarily resident in India, it is your obligation to disclose all those bank accounts, investments, ESOPs, shares, whatever you have got in the foreign jurisdiction. So you must, as a consultant, as a professional also, ask the client, if you know that the person has come back from a deputation outside of India, you must ask whether you are holding any bank account, you are holding any shares, you are holding any investments, or you are holding any social security account. Because the social security accounts are very, very common. Whenever a person goes outside of India, and if India does not have a social security arrangement, you might end up having a social security account. And that social security account itself is a foreign asset that also needs to be disclosed. So these are the kind of broad considerations which we should be keeping in mind. I'm not delving down into details of each and every aspect because we have short time. In fact, each and every part of this presentation can have a separate session on it, but we will be touching upon key considerations so that we are meeting the time. So the other thing is, now we come to the inbound expatriates. So any questions till now? I would be happy to answer. So not really. So anybody can say what are the basic issues they face in inbound expatriates or outbound expatriates, means any situation which they have faced and which they find to be hard to handle at their end. So we can answer those things also, and we can interact, and we'll also learn from your experience. So I would be happy to have the queries as we go along. Okay, so no queries as of now, so we'll move on. So inbound expatriates, we see that a lot of multinational companies, when they set up subsidiary companies or associated joint venture companies in India, they send their people to Indian companies on deputation, say for example 1 year, or also sometimes long-term assignments. And you would see many times that some part of the salary is paid in India, but majority part is still kept on paying in the foreign country, in the parent company, in the home country itself. Now what happens is that the Indian companies are many times not even aware that what kind of salary is being paid outside of India, and that is not a solution. Indian companies who are employer now for the period of deputation or for the period of secondment, they are obliged to know what salary is being paid outside of India and withhold tax on those payments as well and deposit to the Indian government. Why it is so? Because for the period of deputation, these services have been rendered in India only. And the employment services, as I mentioned earlier, are taxable in a jurisdiction if they are exercised, if the employment is exercised in that particular area, jurisdiction. So therefore, you must interact with the parent company and ask that whatever salary or emoluments you are paying to the expatriate employees deputed to India, you must disclose those figures to us. Or even if not to the company, there must be a consultant outside of the company which knows about all the emoluments, and while filing the TDS returns and while issuing the Form 16, all those salary components should be included there. Secondly, what happens is that many times these expatriate employees are also entitled to ESOP schemes which are running in the home country. Now for the period of employment which has been rendered in India, one must be careful that these ESOP, the values of these ESOPs are considered for the tax filings in India as well as for the TDS purposes. Even if there is no allotment made by the Indian company, but if the ESOPs have been exercised in India, exercised during the period which person is rendering services in India, you must be very careful. There is a very big controversy in this particular arena, is that if there is a vesting period of say for 5 years, the person when the grant of ESOP was made was not in India, but in between 2 years was spent in India for employment, which was rendered towards the Indian company. After the completion of 2 years, the rest of 3 years were also spent outside of India. And after the period of this 5 years of vesting, the ESOPs, when they are allotted, when they are exercised by the expatriate employee, the person is not present in India. Now there is a controversy which says that even if the person is not present in India at the time of exercise, the vesting period, 2 years of those vesting period were spent in India, and therefore this particular ESOP perquisite value should be proportionately taxable in India. Now this is something which is gray area. The law is not very clear. Companies are taking separate positions, and therefore you must be aware that what should be done. It may also happen that for the vesting period, the entire vesting period of say for example 4.5 years, the person was not present in India and was rendering services outside of India. But during the last 6 months, when the exercise was happening, the person had come to India, and at that point of time, that exercise time, the person is taxable in India because the services are at this time rendered in India. Now the Indian tax authorities may come and say that we don't bother about where the services are rendered. The exercise has been done at the time when the person is taxable in India and the employment services are being rendered in India. So therefore one must be careful in how should the value of perquisites be allocated to the period of service rendered in India. The companies or the expatriates can take a position that yes, we will be taxable in India only for the part of the services which we have rendered here while we are present here, and not for the other things. So therefore these are the issues which crop up while dealing with inbound taxation, inbound expatriates. Now the other thing is similar to the outbound expatriates. If an inbound expatriate is on a long-term deputation, say for example 3 years, then typically in a third year the inbound expatriate becomes a ordinarily resident. Now in that case, the foreign assets must be reported in the Indian income tax return, and also the global income becomes taxable. So we should be careful about reporting requirements as well, and we should be approaching the expatriate employees to furnish the details which are required to be reported in the income tax return forms. Now the last point, which is very interesting, which we have used in our practical scenarios, is that the person when he goes back, as we discussed in the outbound expatriates, when they're coming back, the timing is important. When the person goes back, say for example after a long-term assignment, the person has already become an ordinarily resident. In that case, what happens if the person leaves India after a period of 60 days, then the person keeps to hold the residential status as ordinarily resident in the year of leaving as well, right? Because if you would remember in section 6 of Income Tax Act, there is a clause which says that if a person who is an Indian citizen goes outside of India for taking up employment, then the period of 60 days will be considered to be 182 days in earlier years. Now it is replaced with 120 days. Now you can say that non-discrimination clause which is there in the income tax treaties, it says that a person of Indian nationality shall not be given some benefits which are not available to a person of the foreign nationality. So the person of foreign nationality cannot be discriminated against, and therefore you can say that the provision which are applicable to the Indian citizens shall equally apply to the foreign national also. Wherever the person is national, you should see whether India has a tax treaty with them, and whether there is a non-discrimination article there or not. And in fact, in the first paragraph of the non-discrimination article, you would find that there is a clause that the foreign national cannot be discriminated against and cannot be put upon more onerous provisions which are not applicable to the Indian citizens. So this is one thing which can be considered. And say for example, if a person leaves India in July, so if you would see strictly the provisions of Indian Income Tax Act, you will find that the person remains to be taxable, as ordinarily resident. Now what happens is that if he remains to be an ordinarily resident for the period when he has left India, for the remaining period of year also, whatever he has earned, his global income is taxable in India. So this application of non-discrimination clause can help you in saving and taking a position that the global income is not taxable in India, and we become a non-resident because we have gone outside of India for taking up employment. So these are some of the issues and some of the important points which we should keep in mind while dealing with the individual taxation in cross-border transactions. So I'll just come back and see whether there are any queries. Not yet. I'm not sure whether I'm making all sense or I'm making no sense.
And definitely, Anshulji, you are making very good presentation. You still there is no query as you have cleared.
Good. So I'll assume positively that I'm making all the sense.
Yes.
Great. So moving on to cross-border payments. We should be now. We are faced with all the times these kind of cross-border payments. We keep on making payment of royalty, fee for technical services, dividends. There are a lot of acquisition. If there are mergers and acquisitions happening, you may encounter a deal where you need to withhold tax on capital gains, or if you are purchasing goods from outside of India, or if you are making payment of commission for foreign sales, for export sales, those kind of income can be classified as business income. Or if you are making certain other income, payment of other income for which the foreign vendor is not into a business of, say for example, guarantee fees. Guarantee fees is generally a controversial payment wherein the nature of the guarantee fee, the nature of income of guarantee fee is still under litigation. So one must be very careful in determining the nature of that payment. So we must be looking at the double taxation avoidance agreements, the articles which are dealing with these specific kind of income. And even though the royalty income may be a business income for the foreign vendor, but because there is a specific clause in the act also, as well as in the double taxation avoidance agreement also, and the tax rate is at a beneficial rate of generally 10% in the act, or if you would go into the income tax double taxation avoidance treaty, you would find a beneficial rate of either 10% or 15%. And 15% was also used to be beneficial in earlier times when the tax rate in the domestic tax laws was 25%. So many times you might find that the rate in the treaty is also beneficial for the past litigation or the past issues which are pending, or the assessments which are open, or the reassessments which have been opened as on date. So one must be very, very careful about what is the nature of actual payment you are making. Now in terms of royalty, fee for technical services, one must be very carefully looking at the equalization levy provisions, because many times what happens is that the new equalization levy provisions which were introduced by Finance Act 2020 on the e-commerce platform operators, you might find that the scope of royalty and scope of equalization levy on e-commerce operator is somewhere overlapping. Now for financial year 2021 there is a ambiguity, because the while making the amendment they made an exemption provision in the Income Tax Act, but they provided that the exemption will be available only from 1st of April 2021. Means for all the supplies made after 1st of April 2021, the exemption from the Income Tax Act on royalties or fee for technical services will be applicable. So this is an ambiguity, and we are hoping that probably this ambiguity will be removed from in the Finance Act in the budget which comes up next month. But till the time, we should just ignore it as of now, and we should carefully see that if the payment has got covered in equalization levy, whether we are required to withhold tax under the normal provisions of Income Tax Act or not. Generally you will not be, right, barring this ambiguity for financial year 2021. So now also you will need to see whether these royalty payments or fee for technical services payments are being provided through online medium or not, whether this can be said to be provided by an e-commerce operator or facilitated by an e-commerce operator or not. If it is not, then you must see that how you should tax it, whether it should be taxable as per Indian Income Tax Act, or you should be taxable as per the the double taxation avoidance agreement. Now, many times you would find that the tax rate of 10% in domestic tax law is itself beneficial. Means in UK, US, the treaty rate of royalty and fee for technical services is generally 15%. But in some of the treaties, say for example, Japan or some other treaties, the tax rate is defined as 10%. Now, taking benefit of treaty will save you the surcharge and the cess which is payable as per the domestic tax laws, which is not payable under the treaty because the rate of 10% is all inclusive. So therefore, if you have to allow treaty benefit, you'll have to see that what documents you need to take. So there is a rule 37BB which says that the treaty benefit can be allowed only if the foreign party provides you with a tax residency certificate and Form 10F. And apart from this, generally we also ask the clients to take no PE declaration, wherein the foreign party declares that I don't have a permanent establishment in India or do not have a fixed base available to me for conducting business operations. And also for the finance department or for the tax department who is making, deciding upon the tax requirement, they must also see the copies of contract between the parties and the copies of invoices at least. Because ultimately, whenever the assessment will be picked up later on, the TDS assessment or the normal assessment, you will be asked for all these details. So one must be handy with all these details so as to take an appropriate decision. Also, whenever you are going to a chartered accountant for issuance of a Form 15CB, he will also ask for all these documents so as to make an opinion and to sign the Form 15CB and advise you regarding the appropriate deduction of TDS. So therefore, these are the documents which we must be aware of. We must be taking into account. Also, if there is no tax residency certificate, you will not be able to allow beneficial provisions of the treaty. Also, you will not be able to provide the taxation at the rate of 10%, because you may recall that there is a section called 206AA. 206AA says that if a foreign party does not have a PAN, means it also applies to domestic parties, but I am talking about international transactions. So if a foreign party does not have a PAN in India, you will apply the rates applicable under the Act or 20%, whichever is higher. So in those circumstances, if we do not have PAN, so at the first instance, it looks that the tax rate of 20%, the TDS rate of 20% will apply. But the rule 37BB provides an exemption, and it says that if the foreign party does not have a PAN, but they have provided you with a tax residency certificate and Form 10F, you can still allow them the lower rate as per the Act itself, and 206AA provisions will not apply, will not be attracted. So this is something which can be used very beneficially, which can save the foreign parties the hassle of obtaining a PAN number in India, and it will also help you deduct tax at a lower rate. And most of the time when the contract is on net of tax basis, it can help you and save money, because in net of tax you have to make payment of say 100 rupees. Whatever the tax is to be there, you have to bear it in India. So whatever tax saving you are making by obtaining these kind of documents, it is going to add up to the resources of the company itself. So moving on, there is also a possibility that you can approach the income tax authorities and obtain a lower withholding tax certificate. And mostly these kind of lower withholding tax certificates are obtained in the transactions where the capital gain arises. Say for example, if you are purchasing shares from a non-resident, or you are purchasing property from a non-resident, NRI. Now, whenever you are purchasing a property from an NRI, the rate of 1% TDS will not apply, as which is applicable in the domestic provisions. But Section 195 applies there, and whenever you are making a payment to the foreign person, you'll have to deduct tax at the highest rate. So for example, if it is a long-term capital asset, you'll have to deduct tax at 20%, or if it is a short-term capital asset, residential property or a commercial property, you'll have to deduct tax at the rate of 30% plus surcharge and cess, whatever is applicable, depending upon the sale consideration. And as a payer, as a deductor, you cannot give benefit of the cost which has been incurred by the seller. So the cost of acquisition of property. For determining the actual capital gain which is liable to tax, we recommend that you must approach the income tax officer and obtain a lower withholding tax certificate under section 195 or under section 197, whichever is applicable. So therefore, in that circumstance, you can significantly bring down the cost of TDS at the time of transaction itself. Similarly, if there is a foreign company which is doing a long-term project in India and they are earning income from Indian customers, and they have formed a permanent establishment, they have created a permanent establishment in India, they can also approach the income tax authorities to say that we must be given a lower withholding tax certificate. Because in absence of this lower withholding tax certificate, the Indian customer is bound to withhold tax at the rate of 40%, which is applicable to foreign companies, right? So foreign companies, if they are earning any revenues from India, their entire revenue shall be subjected to a 40% withholding tax. Now, this is a huge kind of outgo at the time of payment which they are receiving, and therefore, in order to save this working capital blockage, generally the foreign companies who are executing long-term projects in India, they approach the income tax officers. They provide the full projections, the cost which they are going to incur for executing the project, and say that, say for example, we are earning 2 crores of revenue, but we will be incurring 1.5 crore of expenses as well, and then the tax liability should only be on 50 lakhs. So the income tax officer review all these documents and issue a lower withholding tax certificate. So this is also something which can be explored and which should be followed for saving the taxes at the first outgo itself, right? So moving on, we'll also now we discuss the various tax saving opportunities which we can see and which we can evaluate. There are certain compliance requirements also which we have to make while making a cross-border payment. First and foremost, which comes to mind, is the obtaining of Form 15CB, that a chartered accountant has to issue a certificate certifying that what kind of tax need to be deducted, and only then the payment can go outside of India. You will also see that most of the bankers will also come back and say that we need a Form 15CB. Without 15CB, we are not going to make the remittance outside of India. Now, there are certain exemptions which have been provided in the rules that without a Form 15CB also you can make a payment. What is that? First and foremost is that the payment, if it is less than 5 lakh rupees and for the one party within a year. Now, there is an ambiguity in this particular provision. Some of the consultants say that no, 5 lakh rupees is to be seen qua the payer, not the payee. But most of the consultants in the industry, as well as the industry people themselves, they say that no, the 5 lakh exemption has to be seen qua the payee, yani ki the recipient. So if the recipient are 10 and each one is receiving less than 5 lakh rupees of payment, then the exemption will apply to each of the payee. And the payer means if I am the deductor, I need not obtain a Form 15CB from a chartered accountant. And I can only file Form 15CA, which is a self-declaration, to make the payment and remittance outside of India. And if you go and talk to the bankers and show them the regulations, most of them do agree, and they generally do approach their senior persons, but finally they agree. So this saves you the cost of chartered accountant. I am saying so being a chartered accountant, but yes, if the company can save the money, this is something which can be done. Also, you need to check which part of Form 15C or CB needs to be filed. And also, you need to see that there is a complete list of transactions wherein Form 15CA is also not required to be filed. So you can just make the payment as such by just filing some RBI Form A1 or A2, whichever is required. And you can just make the payment without even filing Form 15CA or 15CB. Right? So then moving on, you also need to see what are the specific transactions. There are certain, as I mentioned, guarantee fee versus interest. So many times people confuse guarantee fee with interest payment. But the guarantee, wherein the parent company, say for example, has provided a guarantee when Indian entity has obtained a loan from Indian bank or maybe from overseas bank, generally what happens is the parent company, which is the ultimate parent company, or having a strong financial position, they provide guarantee. Now for providing that guarantee, they charge a particular fees from the Indian entity. Now when we are making a payment of this guarantee fee, most of the chartered accountants feel that this is in the nature of interest, but it is not. It is not in the nature of interest, because the parent company which has provided the guarantee has not provided any debt to the Indian company, and interest is something which is a payment due on the debt incurred. So it is in relation to the debt, it is for securing the debt, but it is not for the debt incurred from the parent company. So therefore there is a case also of Johnson's Method which says that a guarantee fee is in the nature of other income. Now, whether the guarantee fee is in the nature of other income or is in the nature of business income for the parent company, this is a matter of facts which can be determined by seeing whether the parent company is regularly giving guarantees to various companies across the group, and whether it is treating the income as business income. So this is something which needs to be find out from the facts, and it is not just as simple that guarantee fee will be interest and 10% tax rate will be deducted. Why I'm saying so is that on the payment of other income, which is taxable in India, the tax rate goes up to 40%, whatever is the base rate applicable to the foreign companies. Whereas for the taxation of interest income, the beneficial provisions of the TTAA will apply. So therefore, we must be very careful in overseeing and reviewing the transaction, which is the determination of the nature of the payment. Also, if you are dealing with foreign vendors which are partnership firms, or say LLPs, or normal individuals, you must see whether the Article 12 will apply or Article 14 will apply, because the nature of transaction can be provision of consultancy services or technical services, which is covered by Article 12 also. But there is a specific article in the treaty which deals with the taxation of individual professionals and partnership firms. Now in individual, in the Article 14 also, you would find that in some treaties only individuals are mentioned, whereas in some other treaties partnership firms of professionals are also included in the provision. So you must be very careful whether the provisions of Article 12 will be applicable or provisions of Article 14 will be applicable. While we come to the cross-border incomes, the foreign income, we'll dealing with one case law wherein this particular issue was dealt with. Now, most favored nation clause is very, very important, and it has saved lot of money to many multinational companies. What happens is that if you would see the general provisions of the double taxation avoidance agreement, DTAA, you would find a very broad definition of, say, fee for technical services in the treaty, because the treaty was signed when the Indian government was not willing to restrict the definition of the fee for technical services. But at a later point of time, Indian government enters into a similar treaty with a country, which is member of OECD, or which is a member of particular association, wherein they have restricted the scope of taxation of fee for technical services. In that case, what happens is, in many treaties, it is written at the time of signing itself in the protocol, which is at the end of the treaty, that if India signs a treaty which provides some beneficial provisions later on, then those beneficial provisions will automatically apply to the old treaty also, right? So India agrees a beneficial provision with a third country, but that beneficial provision will apply to the first treaty also. This is called most favored nation clause. And by virtue of these clauses, many French companies, many other companies in Europe, wherein the most favored nation clause was available, even though the taxation in the original treaty was much more broader, they were able to reduce the tax liabilities by using this most favored nation clause. So whenever you are viewing or reviewing the tax provisions, taxability of a cross-border transaction, you must see whether this particular treaty has a most favored nation clause or not. And if you would see that there is a treaty, very very lesser known treaty with India, between India and Slovenia, which restricts the tax rate on payment of dividends to 5%. Now, you will not find many treaties where the dividend payment is restricted to 5%, and Slovenia is an OECD member. So you can see that wherever the most favored nation clause is available in the treaty, whether you can reduce the tax rate of dividend payout to shareholders to 5% or not, it will save taxes for the group. So this is something which you should be aware of. Then there is also a concept of pass-through entity. Pass-through entities, as we know, that there are certain countries wherein the partnership firms are not taxable, not taxed as such in the capacity of a partnership, wherein the India taxes partnership as a separate taxable unit, whereas in UK, US, or many other countries, the partnership is not taxable as such, but the partners are taxable. So in those cases, we say that these are pass-through entities. These are not taxable in their own sense. When you are making a payment to these kind of entities such as LLPs, LLCs, limited liability corporations in US, these are pass-through entities. They will never be getting a tax residency certificate in their own name. Now, what happens is that generally the tax authorities issue a certificate saying that we certify that the partners of this LLC or the shareholders of this LLC are residents in India, resident in US or resident in UK. In those circumstances, you need to see whether all the partners are resident in UK or there are certain partners which are not residents in UK. In that case, you will not be able to apply the India-UK treaty to the entire payment being made to those parties. You'll have to bifurcate and see that if the partners are resident in some other country also, then probably for part of that payment, the other treaty will apply. And then you'll have to obtain a separate tax certificate, tax residency certificate from that partner. So therefore, the status of the entity to whom you are making a payment is also very important to be determined, whether this is a company or a partnership firm or the person who is taxable in his own right or not. Therefore, you must keep in mind and visualize what is the tax liability. Then obviously the transfer pricing must be considered. If you are dealing with a related party, if you are dealing within the group, you must take care of the transfer pricing regulation and see whether the price you are making, price you're paying for obtaining a service, whether if it would have been a third party, you would have paid the same amount or not. And there is benchmarking studies, transfer pricing compliance, the entire thing will be required to be done. Moving on to foreign income. Any queries right now? There is one query, I think. Anshulji's any exemption came from for the NRI who came in India in March 2020 and stuck in India due to COVID, and now residential status is changed to resident as they are in India for more than 80 days. So Atulji, this exemption came in, there was a circular which came in, but this circular applied only for financial year 1920. This circular has not been extended to financial year 2021. And therefore, if the person is continuing to stay in India in financial year 2021 also, as on date, there is no exemption, right? So the exemption only applies for financial year 1920, and that too only for the period starting from 23rd of March till 31st of March. They are only excluding that period. They are saying that the complete lockdown was only started from 23rd of March and it remained till 31st of March. So if you were there in India till that time, we will exclude these 8 or 9 days. So that is actually saying not helping much. The government must consider that for the period of financial year 2021, they should also come up with some exemption, but that is still
So
awaited.
Anshulji, any hope, any positive hope for coming this notification for this year also? Because
Sir,
in this
can't
year,
say. I mean, this time the government is not listening too much to the professionals because this demand has been long standing. In fact, even from the May itself, the professional community has started saying that why are you not issuing why are you not extending this, circular to the next year? But as of now, I have not seen anything coming from the department. And also department is saying that the lockdown had been lifted since June, mid of June somewhere, the almost lockdown was lifted, and also the overseas flights were started. The bubbles were created. So if you had the intention to go out, you could go out, right? So
Okay.
somewhere government has also got the logic, but this is a gray area. There's not black and white somewhere,
Okay.
right? So coming on to my presentation, foreign income. So when we are earning, now we had already spoken about the payments which are making outside of India. Now Indian groups are growing, Indian companies are growing, they are exporting income, they are making investments, they are earning income from outside of India. So again, the determination of nature of income is very, very important, because some income types are taxable in the foreign jurisdiction at the gross basis taxation, whereas certain incomes like business income or capital gains may be taxable on the net basis. So whenever you are earning income which are taxable on gross basis, you should be very much aware, or you should take into consideration whether there will be any tax deduction from the foreign customer. So if you are, means I have seen live case just a few weeks back, where in the Indian company was not even aware that their TDS has been deducted. They were just receiving money short of money, and they were keeping the company as debtor, and they were not aware that their tax has been deducted. And when they approached that we have not received the full payment, they said that we have made the full payment, your tax has been deducted in the foreign country. Now, when they asked for the tax deduction certificate, that also took time, and the timeline for the filing of return is expiring, the timeline for finalization of books of accounts is expiring, and they were caught unaware, totally unaware. Now, what happens is that many a times you must also be aware whether the income was taxable in the foreign country as per the provisions of India, as per the provisions of double taxation avoidance agreement with that country. Now, what happens is that if the income is not taxable as per the provisions of the double taxation avoidance agreement, income tax authorities generally take a plea that we will not allow you a tax credit of the foreign tax, because this was not paid in accordance with the provisions of the convention of the tax treaty. Because the convention, the tax treaty says that the tax credit will be allowed only if it is paid in accordance with the convention. So therefore, you must be fully aware as to how and why the tax is being deducted. And if there is something which you can do, you can provide tax residency certificate from Indian tax authorities. If you can provide certain declaration to the vendor, if there are, in many countries, there are certain forms which you can fill, and that will allow you to, get the payment without deduction of tax. So for example, in US, there are WB forms which you can file. So you should be aware, and you should ask the the customer whether you will be withholding my tax or not, and is there something which I can do to save that withholding tax. Secondly, it is very good, and if it is possible, you should agree and negotiate net of tax contract as the foreign companies negotiate with us. So therefore, similarly, if you are providing services and you have customers outside of India, and if you are in dominant position, you should ask for net of tax contract, that boss, we need this much of money. If there is any tax which is required to be paid in your country, you bear with it. We are not bothered about it. So if it is possible, you should do that. Then you should approach the Indian tax authorities for obtaining Indian tax residency certificate. There is a complete procedure about this. You can approach the jurisdictional AO, you can file an application, and for domestic companies, there is no brainer, because domestic companies are resident in India. So it is very, very easy to obtain these tax residency certificates. Similarly, as I talked about the cross-border payments, in the terms of cross-border income also, transfer pricing regulations need to be complied with. Now, going forward, I will be discussing one more thing, that when you are taxing the income on a gross basis in a foreign jurisdiction, say for example, royalty or fee for technical services, you are earning say 100 rupees, and tax at the rate of 10% has been deducted, right? Now, when it gets into your revenue is not taxable in its entirety. So there will be some allowances, disallowances, some deductions which would have been claimed, certain expenses which would have been incurred, right? And you would be claiming those expenses for computing the taxable income. Now, say for example, if the company had earned a total revenue of 500 rupees, Out of this, 100 rupee was foreign income. Now, on 500 rupees of income, the revenues, say for example, the net profits come out to be 40 rupees. Now, if we calculate the net profit ratio, the taxable income comes to be only 8%. Now, income tax authorities can come and say that out of the 100 rupees which you have earned from foreign customers, only 8 rupees have been taxed in India because your net taxable profit rate is only 8%. So you would see that the doubly taxed income will reduce from 100 to rupees 8 only, because they will say that we have not even taxed 100 rupees, we are only taxing 8 rupees, because of the 92 rupees you have already taken a deduction of various expenses and other thing. So therefore in India you are making a payment of tax only on 8 rupees. Now say for example on 8 rupees you make a payment of tax of 25%. Say for example you are in the lower bracket, and 25% will come to what would be 2 rupees. So 2 rupees is the foreign tax credit you will be eligible for. So therefore you must be very careful how you are calculating the foreign tax credit, and whether there is a possibility to claim to take a position that boss, we have not incurred any kind of expenses against my foreign income. Or even if I can say, take a position that the 10% of rate, which is beneficial rate, is considered after deemed deduction of all the expenses which have been incurred to earn this income, and therefore a beneficial rate of 10% is applicable. Had it been taxable on net income, I would have calculated the rate at 30% or so. So these are the kind of provisions we should be aware of while claiming the credit of foreign taxes in India. Also, I was talking about that you must be careful in determining the status of the company, of the foreign vendor. Similarly, when you are a professional firm, say for example, we are chartered accountant firms and we are rendering services to foreign companies or foreign clients, there may be a situation where Article 12 versus Article 14 debate comes in. In the very recent case of Amarchand Mangaldas, the income tax authorities denied the tax credit which was deducted by a Japanese customer. Why they denied it? As I mentioned, income tax authorities said that you are not liable to pay tax in Japan because it was you are a partnership firm, and as per Article 14 of India-Japan Treaty, partnership firm should be taxable only in India because you do not have presence in Japan. You do not have rendered services for more than 90 days. You do not have a permanent establishment there. So you are not liable to tax there. And when you are not liable to tax there, you have suffered withholding tax. We are not going to allow you foreign tax credit. Now, in this case, the tribunal has held that in India-Japan Treaty, the partnership firm is not covered under the provisions of Article 14. So now the company, the professional firm was brought back to the provisions of Article 12. So they have said that Article 14 only applies to individuals. Therefore, partnership firms will keep on continuing to be taxed in Article 12 only. Now, if you flip the situation, if there is a Japanese partnership firm providing services to Indian customers, and if Indian customer is making a payment, then what should they do now? They should now consider the applicability of Article 12 instead of Article 14. So therefore, these kind of things are intermingled, even though Amarchand Mangaldas case is on the side of income recipient, but that will equally apply to the payment side. So as I said, that foreign tax credit claim is very, very crucial. The new foreign tax credit rules have been, introduced a couple of years back. I think 3 years back, foreign tax credit rules were introduced, and they say that you have to compute the foreign tax credit on an income basis. You have to determine on which income I have incurred foreign tax, and therefore whether I should be eligible to claim that credit or not. Another important aspect in foreign tax credit is that in some countries like US, there is an income tax which is applied by the central government, which is called federal government, and as well as their state governments also apply income tax act. Now in India, we are not even aware about these concepts many times, because in India, income tax is a central subject only. But in some countries, income tax is a central subject as well as a state subject. So you end up paying state taxes also and federal taxes also. But if you would come to double taxation avoidance agreements, you will see that the taxes covered, the definition of taxes covered is covering only the federal taxes. Now, because of this, there were some litigation which happened, and in some of the case laws, it has been held that even if there is a state tax paid as an income tax, that should also be allowed as foreign tax credit in India. Now, if you have made certain state taxes payment in foreign country, that can be allowed as foreign tax credit, and that can help you save taxes in India. So therefore, one must be looking after all these issues and inquiring about all these things from a client, or if we are serving a company itself as an employment, we must be aware about all these things. Then the next point about foreign tax credit is underlying tax credit. Underlying tax credit is something wherein the tax paid by the subsidiary company can itself be claimed as foreign tax credit in India. For example, in India-Mauritius Treaty. So this is also a very good concept wherein even though there is no repatriation of profits from India, even though there is no dividend coming in, you can still claim the underlying tax credit. So there are certain terms and conditions which are provided in the double taxation avoidance agreement, and you can see and look for those things. Now I'm mindful of the time also. I'll be rushing through in 5-10 minutes. So the dividends, if you are earning from a foreign joint venture company or a subsidiary company, if you are holding more than 26% of shares, the dividend is taxable in India at a rate of 15%. And then if it is clubbed with 80M, which is the new section which has come in this year, there is also a possibility that you can plan taxes around. If the Indian company also makes payment up to its shareholders, there is a very good tax planning and tax arbitrage which can be claimed. So this is a complicated issue. So I'm just putting it into your minds for food for thought. So you can discuss it later on. Now we'll come to capital contributions. The capital contribution means whenever you are making capital contribution to a foreign company, or when you are receiving share capital money, or money for convertible debentures. In those circumstances, what needs to be done? So first and foremost thing is, when you are receiving share capital and you do some valuation in terms of RBI regulation, whether this transaction itself can be said to be governed by the transfer pricing regulations. So this case was a very prominent case in Vodafone judgment, wherein the income tax authorities said that you have valued your share at rupees, say for example 7,500 per share, but the actual value of your share is somewhere around 15,000 rupees. So the balance of 7,500 is something which you should have earned. You should have gained. You should have got from the parent shareholder company, and because you have not earned it, I'll consider it to be your income. Now, Bombay High Court held that this is a capital account transaction. Even if I would have got 15,000 rupees, that would not have added to the income of the Indian company, because it would have gone to the share capital. So therefore, transfer pricing is not applicable. And the CBDT also did a good part, that they issued an instruction, which I have mentioned here, accepting the judgment of Bombay High Court. But the not so good part is that even when the CBDT has issued an instruction, they keep on they keep on having a point number 16 in the form 3 CEB, which asks for the details of share capital contributed to India. Now, you cannot value it. This is not liable to transfer pricing regulations. It is not taxable, even though you have to report it. And once you report the transaction, what happens is that the volume of your international transactions reported as a consolidated figure in the form 3 CB, it increases significantly. Because when you're reporting this, you'll have to report the share capital as well as the share premium. So this is an ambiguity which is still to be resolved, and we are not seeing anything. The other thing on capital contribution is that even though it is not taxable as such prima facie, but there is a section called section 69 which talks about taxability of unexplained income investments. You would have all heard about angel taxation, wherein the investment made by the resident shareholders in an Indian company at a higher value, more than fair market value, is considered to be taxable in the hands of the company. that is not applicable to share capital invested by non-residents. But now what we are seeing very prominently is that the income tax authorities are challenging the credit worthiness of the non-resident shareholders, and they are invariably issuing notices to ask for various documents and evidences to prove the credit worthiness. So what you can do is you can obtain financial statements of the shareholder company or the KYC from the banker of the shareholder, even if the shareholder is individual or non-corporate. Then you can obtain some confirmation from the banks that how long they have been holding accounts, where have they've been in earning that money from, which they are investing into your company, or if they have invested in other companies in India, or they keep on making investments globally. Then you can have those details, because this justifies that they have the capability to invest, right? Or what is the business of the shareholder. So all these documents cumulatively will help you in justifying the credit worthiness of the shareholder. And mind you that there are a lot of judgments which say that if you do not provide any kind of justification, you just say that it is come from banking channels, they are not going to agree to it, and they might tax it in your hands. Then moving on, there are structuring possibilities wherein you can consider having compulsory convertible debentures, where you make the payment of interest, which is tax deductible, vis-a-vis having the equity shares at the first go itself. So you can structure the investments in such a way that it provides tax benefits to the Indian entity as well as to the parent company. Then capital gain taxation on indirect transfers. Say, for example, if the shareholding has changed at the top level itself, your direct shareholding of the Indian company has not changed, but the shareholding of, say, immediate parent has changed. Then the provisions of indirect transfer, which was the case of Vodafone, right? The arbitration which the Indian government has lost recently. So those kind of transfers. Now Vodafone has won because it was retrospective amendment and the transaction was done prior to the provisions were brought in. But if these kind of transactions are happening right now, you cannot maybe escape it. But there are certain provisions of the treaty itself wherein there are a lot of talks about still indirect transfers can be claimed as exempt. These are complicated issues, and probably we can take up in some other discussion. Now I was talking about the inbound investment. Now we talk about outbound investment. Outbound investment also you need to discuss, and you need to evaluate whether the transfer pricing is applicable in India, as well as now you need to see whether the transfer pricing is applicable in the foreign jurisdiction where you're putting the money. Similarly, whether there is a similar kind of Form 3CB or reporting requirement in that particular jurisdiction. Also, in India, whenever a capital is contributed outside of India, that is also required to be reported here. Similarly, the place of effective management rules. The place of effective management means that if you have incorporated a company outside of India, there is a group company, but the entire management is sitting in India and taking strategic decisions while sitting in India, the foreign company can be treated to be taxable in India and as a resident in India, because the place of effective management resides here. Therefore, you must be careful that what kind of substance is there in the Indian in the foreign company. And also there is a notification which provides for an exemption from the place of effective management rules till the time the foreign company does not have a turnover of more than 50 crore rupees. Now, how to compute that 50 crore rupees in itself is a challenge, because whether you need to compute it in the foreign exchange, how to convert it into Indian rupees, that is also something which needs to be seen. Then again, investment structuring, you should go out and see that what kind of structuring can be made from the foreign jurisdiction perspective, and whether there is tax benefits available to you or not. Then you can also evaluate whether an intermediary holding company can be used as a structure wherein you are, say, for example, entering into an African continent, whether a Mauritius holding company can be good, or if you are entering into a European jurisdiction, whether a Netherlands holding company can be good, which can be used to hold IPs also, right? Just not investments. So these kind of strategies must be looked upon. Similarly, you should also look whether there is an exit tax applicable or not. In India, there is no exit tax, there is just capital gain tax. But in some other country, apart from the capital gain tax, if you exit that country, then there is a separate exit tax, particular rate which is applicable, which can be levied. So you must be aware whenever you are entering into that jurisdiction that what kind of tax laws are there and what are the updates in those tax laws. And similarly, the restrictions on repatriation of profits or any dividend distribution tax, kind of a similar thing which is applicable in those foreign jurisdiction, you should be aware of. So I have broadly touched, upon the key considerations which you should be aware of and we should be keeping in mind while doing a cross-border transaction or various kind of cross-border transactions. So I'll pause here and I'll hand it over to Sumit ji, because still I am not able to see any other query right now.
Thank you, Anshul, and I request all participants to post your query right now and later on also. And very wonderfully covered, Anshul. You have entire the cross-border transaction and issue. I also welcome CA Sudha ji Bhusan ji. Madam, please join us. Once again, welcome to you, madam. And
Thank you,
Anshul,
Sumit.
thank you. Anshul, you have covered very well. The topic is so much importance. Then now the second topic of the today's session, which madam has to take care, entry strategy in India, and about Sudha ma'am. She has also delivered 2 3 webinars on this platform in last few months, and she is qualified chartered accountant and company secretary and founder director of Taxpert Professionals Private Limited and multi advisory consulting firm, author of various best-selling books on FEMA and other transfer pricing issues, an independent director in lot of companies, members of various committees of ICAI or ICSI. So once again, welcome to you, madam, on this platform to deliver the topic entry strategy in India. Now I request to take up the session, and before that, I request participant to post your queries, if any, on the first session and later on the second topic. Over to you, ma'am, for your deliberation.
Yes, thank you, Sumitji, for the introduction and for calling me again on your platform. It's always a privilege to be here on your platform. And wonderful presentation by Mr. Anshul. And just to introduce Anshul and myself have the privilege of working together in Deloitte. So,
Yes,
and now we are directly meeting on your platform.
thank
So,
you.
After I think more than 10 years.
definitely, yes. Yeah. So, starting with the topic of today, that is entry strategy into India. Let's start the topic, and I'll be sharing my screen now. Yeah. So we can go without sharing the screen. I mean, I I'll just share the screen.
जी madam.
Yeah, I'll do that. Yeah, so when we talk about the entry strategy in India, it is very essential for us to understand actually why India. So my screen is shared.
Yes, ma'am. Yes, it is
Yes.
clear.
Yeah. So why India and what's happening in India and why everyone has got so much interested in the country now. So we are the country. I'll just yeah. So we are the country wherein the way we have progressed, not only in our regulations, not only in our level of ease of doing business, but also in the way we have liberalized our various industries. So the FDI flow, the foreign direct investment flow that has come from April 2000 to September 2020, as per the DIPP statistics, is around 7,21,000 USD million dollar. So that's the level of investment that has come in India, and it is not that it has come only in the selected few sectors. It is across sectors. So in service sector also the foreign investment is coming. in computer software, hardware, it is coming. From telecommunication to hotel and tourism, everywhere we have the foreign investment in India. And it has been increasing. If you see, even in the COVID times, the investment that has come in India is substantial from all over the world, from Mauritius, Singapore, US, Netherlands, Japan, Russia, from all over the world, the foreign investment has been coming in India. So it's a very good sign of maturing of our economy, maturing of our businesses, that we India as a country has been able to get so much of foreign investments, and it is increasing as well. So that's, I'm sure that everyone is excited to know how to enter India. What are the various ways in which the investment can come in India? So it depends on who you are, basically who you are, who the investor is, and it will go on to, so what, while making the entry strategy in India, one has to understand that who can first of all invest in India, how the investment can be done, how the money can come, and at what price the investment can be made, and in what various modes the investment can be done. So before understanding anything with respect to regulation, one has to the investment have to have the business perspective, that what is your business, what is the foreign investor that is looking for investment in India, what is the objective of that foreign investor to come in India. So objective may be the long term objective may be the short term objective may be to do the joint venture. So depending on the various objectives that the foreign investor may have, there are various options in which the investment can come in India. So very, very essential for us to understand that what are the various options that are available to foreign investor to do the investment in India. And the predominant thing to decide is that what is the objective of foreign investor when the investment is being made in India. Now, I always say, as Anshul ji has already spoken in very detail about the taxation part of it, there are 4 aspects that I always say that one has to see when doing a cross-border transaction. That is allowability, vulnerability, accountability, and explainability. So we'll talk about that sometime in the next session maybe. So one has to see whether in whatever mode the investment is planned to come in, whether that mode of investment is available for investment in India or not. So one has to see that. And also besides that, there are various agreements that is being entered into by India with various countries. So the agreements may be in the form of it may be economic agreement or taxation agreement. So one has also always to consider that it is not only always the taxation aspect of the business that needs to give the priority to. It is more of the business aspect, more of the commercial aspect that one has to understand. So to understand that, besides the double taxation avoidance agreement, there are other agreements also that India has entered into and India keeps on entering into with the various countries, and it depends on from which country the investment is coming. So these type of agreements are like the free trade agreement, preferential trade agreement, or like we have comprehensive economic cooperation agreement, tax information exchange agreement. So these are the various type of agreement that one before entering into India, that is I'm saying besides the DTAA, that is besides the double taxation agreement, avoidance agreement, that these are also the various type of agreement that that India has entered into with the other countries. So if for example the investment is coming from Korea, so we have this comprehensive economic cooperation agreement. So that gives lot of benefit to the trade between the country and India. So those type of agreement one should be looking into, and also one has to look into the whether there is a protection of investment when there is a investment being made in India. So these protection of agreement investments comes from the bilateral investment treaties. So presently, India has entered into these bilateral investment treaties with 86 countries. So if you are a country which has entered, with which India has entered into this bilateral investment treaty, in that case there are benefits that are available, and also there is an enhanced protection of investment that is available. So there are fair and equitable treatment. So this treaty provides the fair and equitable treatment, or it may be that one has to look into whether what is the treatment that is being given to the investment, that is national treatment or it is MFN treatment, that is most favored nation treatment. So all these bits, if it is there, then that says that the investment is bit more secure. So we have this bilateral investment treaty with United Kingdom, Russia, Malaysia, Denmark, so many countries. So if we can structure, if the investment can be stuck, if there is a country from which the investment is coming and India doesn't have a BIT with that country, it may be looked into that the investment can be first placed into the country in which there is India has the bilateral investment treaty, and then from there India investment into India can be made. Also, there are agreements for besides the DTAA. That's what I'm saying. Social security agreements. Now, social security agreements are takes care of the social security of the retirement benefits of the employees of the companies which are working in the respective countries. So if, for example, the employee of Belgium, employee from the company in Belgium is working in India, and since India has a SSA with Belgium, so there are enhanced benefits that are given to the employees of the company in Belgium with respect to the repatriation of its social security. So one should be looking into these various agreements that India has besides the DTAA with the respective country from which the investment is coming. Taxation part I will not be touching, and then there are procedures to be seen, and so procedures to be, then there are procedure and then allowability. So obviously the first and foremost thing is to that whether the investment is allowed to be made in India or not. So whatever sector the company is coming to do the trade in India, to do the business in India, whether it is falling under the sector which is allowed by the government to do business in India. So right now, if we talk about the sector, we have come from the period in which we had only few sectors in which the investment could be done. Slowly and slowly, we are moving to the few sectors in which investment cannot be done. Apart from those sectors, apart from very few those sectors, investment can be done in India. So India presently is liberalized, is open for the world to come and invite the investments in whatever form. So the foreign investor has to decide in what form it wants to come, depending on its objective from India. And also, we not only this, that we are very, very liberalized and very, very rationalized in terms of our procedures. There are so many other advantages that we may talk about when it comes to India. So we are a deep-rooted and highly effective democratic regime. We have well-developed administration and an independent judicial system. Our recovery laws have become very, very strong with the introduction of IBC. Our workforce is educated, hardworking, and skilled, and also cheap. And no one can deny the huge consumer market that the India is. And if there is an investment, if the foreign investor is thinking to invest in India, definitely it moves towards the proximity of the raw material, which depending on the state, every state has its own raw material, on own resources of raw material which can be used. And so suddenly and also there are various schemes which are I'm not talking about the old scheme, but there are so many new schemes also that are coming, and especially the schemes like production linked incentive schemes, a scheme like scheme for promotion of manufacturing of economic components and semiconductors, and modified electronics manufacturing cluster scheme. So there are so many schemes which the foreign investors can use to their benefit. Now, with this brief overview, let me now start the ways in which the investment can come in India. So, as I said, it can come in any way the foreign investor want. It can come in any way. It depends on why you want to come in India. And before coming to India, please check the various agreements that India has entered into with the country from which you are making investment. There are two broad ways in which the foreign investment can come in India. One is incorporated and unincorporated. Now, if we talk about the unincorporated way in which the investment can come in India, there are various ways like branch office, liaison office, project office, that the investment can come in India. Now, why would you, to make it easy decision that whether the investment should come by way of a unincorporated manner or by way of incorporated manner will depend on what's the objective, because the license for the unincorporated entity in India is given for a particular period only. And after that, you cannot do the business in India. So you'll have to shut your shop and go back. So therefore, if the objective is long term, in that case, the company needs to be incorporated in India. However, if the objective is to taste Indian waters, to do the marketing function, or only to look into to do the only the specific uh, type of activities, there is no need to establish the incorporated entity in India. Let me first take you through the unincorporated and by what ways you can establish into India, in which you don't have to incorporate your entity and you just need to take the license from the Reserve Bank of India and you can open the shop in India. However, as it may be relevant to point out here, is that in case of an unincorporated entity, since it is an extension of the foreign entity, it shall be construed as the foreign entity only, and therefore it will be taxed at the rate at which the foreign entity is taxed in India. So the lesser rate of taxation which is available to the Indian company shall not be available. And in case the objective is short term, and the foreign investor can look into to open the branch office, liaison office, and project office in India. So for the purpose of opening of branch office, a simple form goes to the Reserve Bank of India in form FNC, and that comes with the prior conditions that needs to be satisfied. So prior conditions in terms of net worth, prior conditions in terms of KYC. So one has to satisfy the condition of net worth and KYC to be able to establish the branch office and liaison office in India. And there are particular permitted activities only in which the branch office and liaison office can be opened. So these permitted activities which are there for the purpose, which are there for the purpose of branch office are export and import of goods, rendering professional or consultancy services, carrying out research work in which parent company is engaged, promoting technical or financial collaboration between Indian companies, and it is rendering services in information technology and development of software in India, and rendering technical support to products supplied by parent or group company or representing the foreign company. So if these are the objective, the branch office can be opened in India. The branch office can be opened in India. And license office is just a post office. So if you are planning to look into Indian market, or if you are planning to promote the export to India, or you are looking for your raw material sources in India, in that case, license office is a perfect choice. Now, license office can also be opened for promoting technical and financial collaboration between parents and group companies, and it is uh, it acts like a communication channel as well. So these are the only purpose for which the license office can be opened. Now, what happens if if your entity have got some project in India which is rewarded by the Indian company or Indian government? In that case, you are allowed to open the project office in India, and this project office is the permission of project office is automatic. You don't need permission from anyone to open, and it's just that the tender should be there, that there is a tender, and that the project office can be opened. Site office is an extension of the project office only. Now let us see it with an example that there is this company CAP Logistics, and Indian government has awarded the contract to the company and in Germany, and CAP Logistics shall be executing that contract in India. The length of the project is 2 years to execute the project to automation of the Indian railways. What is the entity that CAP Logistics should have in India? So the CAP Logistics doesn't need to have its shop established in India in the form of the WOS, that is wholly owned subsidiary, because wholly owned subsidiary will involve the whole of the process of incorporation in India, and while remittance of the funds back to its home country, in that case there is a proper procedure that will be involved, and also the winding up of the company will be required to take place. However, in case since the project is only for 2 years and there is no work that CAP Logistics have in India after that, so it is recommended that CAP Logistics open the project office in India. It opens the bank account in India. Whatever needs to be funded, it will come in that bank account. And once the project is over, to take back that funds as a profit after payment of taxes. So that's the ideal form of entity for CAP Logistics. Now, let us see this different example. In this, there is a company ANI Plastics in Germany, and the company ANI Plastics is looking for business partners in India, and it is looking for probable exporters to Indian partners. Now, if you see, ANI is into plastics, toys maybe, and they are looking for probable export to Indian partners. So their objective is to create India as an export market only. They will export to various importers in India, and that's their objective. So ANI Plastic should, in this case, should go for license office, because they don't have a project or any project in India, so they will not be allowed to open the project office in India. Now, branch office, if you see, they don't need to open the branch office as well, because they are not earning anything in India. Their object is to act as a communication channel only. So they can open the license office, which will interact with various Indian partners and act as a communication channel between ANI Plastics and various Indian partners. So there is no need for ANI Plastics to open either the wholly owned subsidiary in India or the project office or the branch office. It can very well go and open the license office only. Why do we say that in some cases it's better to open the unincorporated entity? Because if the entity is incorporated in India, it will have to follow all the regulations in India, and also the profits can be repatriated by way of dividend. So it will have to have the dividend, the tax will be required to be paid, all the tax, that Indian tax will be required to be paid, and also the Indian company will be required to be wound off also. So maybe even the objective is not long term, there is no purpose to enter into the incorporated form of business entity in India. In comparison to the previous example, if the objective of ANI Plastic was to serve Indian customer, and if it wanted to manufacture in India and sell in India, in that case, it made a lot of sense for ANI Plastic to open the shop in India, to open the shop in India by way of the incorporated entity. So let us now see the various comparison points, that what form of entity is good, and what form of entity, various parameters in each form of the entity. So if you see incorporated, the license office, branch office, and project office are unincorporated entities, and joint venture is an unincorporated entity, which means that it's a separate legal entity, and it will have it is registered under the Indian Companies Act, and it needs to follow all the requirement of the incorporation in India. The permission is whether it with regard to the permission required. Now, whether any permission is required to open the unincorporated entity in India by way of license office, branch office, or project office, yes, the prior approval of Reserve Bank of India is required to open the LO, BO, and PO in India. However, the complete power has been delegated to the AD bank. So now the bank have been given the complete power that, okay, if you found suitable, if the KYC has been checked, and if the network criteria has been met, in that case, the banks can freely open the LO, BO, and PO. However, the UIN that is being allotted to LOBO, that is allotted by the Reserve Bank of India. So after the banks take the decision, it sends the application to the Reserve Bank of India only for allotment of UIN. So it is only for the allotment of UIN for the statistical purpose. However, the power of giving approval has been given to the AD banks, that is authorized dealer banks, which are permitted, category 1 banks, which are permitted to deal in the capital account transaction. Now, with regard to the joint venture or WOS, whether the investment can be done in India, and if it can be done, how, whether any permission is required. Now, whether an investment can be done in India in a wholly owned subsidiary or a joint venture, it will depend on the sector in which investment is coming. So the sectors in India are divided into 3 types. One is, I will say 2 types only, not 3 types. So one is the prohibited sector. So the prohibited sector are the sectors which are notified to be prohibited. That means that no investment can come in these sectors. So these sectors like real estate also, it is the trading in real estate that is specifically been prohibited, or something like the speculation businesses like chit fund, lottery business. So those are the absolutely prohibited sectors. That means no investment can be made in these sectors. So if you're planning to come in these sectors which are prohibited, say Nidhi company or trading in transferable development rights or manufacturing of cigars and all. So in these sectors, sorry, the investment cannot come because these are the prohibited sectors. Now, there are some sectors in which approval of central government is required. First of all, it may be that after certain percentage of ownership, the central government approval is required, or from the beginning only, the central government approval is required. For example, in digital media, or we have defense, or we have telecommunication, or brownfield pharma. So these type of sectors in which the approval from central government is required. So before investing in India, one has to take approval. It is a prior approval. So investment, the approval from the central government is required. However, there are certain sectors in which the investment at the beginning, the approval is not required. It is after reaching a threshold limit only the approval is required to be taken from the central government of India. Now, the third sector, which is actually not a sector, anything else, which is anything else will fall under the automatic route. So anything else which is not falling into the prohibited sector, or approval route, though everything else will fall under the automatic route, that goes to say that only the intimation to Reserve Bank of India is required. No prior permission is required to be taken. What does it mean? It means that you come open a company in India, make the remittance in India, and after the remittance have been made in India, after the remittance have been received in that company, within 60 days of that remittance, there has to be allotment of shares, and after 30 days, there is some form called FCGPR that needs to be filed with the Reserve Bank of India. So that's regarding the permission required. Now, let us see the various filings that are required to be done with in these cases of entities. So license office, LOBO and PO, there is an annual activity certificates that goes with the Reserve Bank of India that needs to be filed. And in case of a joint venture or WOS, there is an annual return, FLA return, that talks about the foreign liabilities and asset that goes to the Reserve Bank of India. As we had now coming to the activities that are allowed to be undertaken. So we had already discussed it in the beginning that the activities that are allowed to be taken by LOBO and PO are very limited, and as have been specified in the regulations. So license office can do only cannot earn profit in India. Branch office can undertake few activities, and project office can be opened only if there is a project. So that's how the LOBO and PO are the activities are restricted. However, if you think that you need to do only these activities, there is no point opening the wholly owned subsidiary. Now, what wholly owned subsidiary can do will depend on the memorandum and article of association of the company with the what is the object with which the company was opened in India. However, as we have understood that it obviously cannot fall into the sector in which the investment is prohibited, and if it is falling into the sector in which prior approval of central government is required, in that case, the prior approval of central government will be required before opening office in India. Repatriation of profits. Obviously, that is one of the most important determinant of how the profits will be repatriated. The profits in all cases are repatriable if the investment has come on the repatriable basis. Now, in LOBO and PO, LO is not allowed to earn any profit in India. So it can, as we saw, that it can do only act as a communication channel. So license office does not earn any profit. With regard to the branch office and project office, they can remit the profit after deduction of taxes in India. And in case of the joint venture or wholly owned subsidiary, they can also remit the profit after payment of taxes in India. Coming to the liability in case of LO, BO, and PO is unlimited, and in case of wholly owned subsidiary or joint venture, it's a limited liability. Mode of funding, the LOBO and PO can maintain themselves out of the funding from the head office, and it can, in case of BO and PO, it can also earn profit from the permitted activities. Exit options, the permission by the RBI is in case of LOBO is only for 3 years, so it has to close after that specified period. In case of PO, there is a specific period only for which it can be it can work in India. And in case of the incorporated entity in India, obviously it needs to go through the process of winding up or sell its shares. That is the exit option that is available. Repatriation of assets is available, and income tax return and all this, it needs to follow the various provisions under Income Tax Act, and it needs to file the return in India in all cases. So even if the LO is not allowed to earn profit in India, it needs to file the return in India. And as far as the company in the form of incorporated entity is concerned, in that case, the global income of that company in India is taxable in India, being resident in India. So that's a broader picture that we have with regard to the unincorporated entities in India that can be opened and incorporated entity in India. So that's how it can be opened. Going forward, there are various regulations that one has to, there are these, see, so when you are coming into India, first, if you are established into India, you have an incorporated entity into India, in that case, the Indian entity in any case will need to follow all the Indian regulations, being the entity registered in India. There are the various regulations that needs to be followed ranges from the Foreign Exchange Management Act, NDI instruments, then mode of payment and reporting of non-debt instruments, and then FDI policy that has recently come in October 2020. With regard to, let us now understand, so who can invest in India? Who can invest in India? Any person can invest in India. So what you have to see, whether I can invest in India, you have to see what you want to invest in India. So where do you want to invest in India? You want to invest in an unlisted company, you want to invest in an LLP, you want to invest in a listed company, you want to invest in a startup, you want to invest in a FC, foreign venture capital, in the capital investment, you want to do the investment in the privileged sectors, that is the 9 sectors. So you want to invest as an IDR or GDR. So it depends on who you are and in what you want to invest in India. So for each of these, see, these all depends on what you, in what, when it comes to the incorporated entity, in what do you want to invest in India. So if the investment is coming, you want to invest in a listed company in India, then the investment can come through the foreign portfolio investor route, or it can also come through the FDI. If you want to invest in an unlisted company in India, if you want to make the investment, so if you want to make the investment in an unlisted company, so all the investment will be in the mode of foreign direct investment only. And depending on what we are soliciting the investment into. For example, we are soliciting the investment into startups. As a country, we want our startup ecosystem to flourish. We want that few sectors like biotechnology, etc., should flourish. So therefore, we are giving as a country there are certain incentives that are given in case the investment is coming into these entities. In SATA, for example, you can also have the convertible note issued to the foreign investor. So, how, in what entity the foreign investment is coming, the level of regulation is dependent on that. And it will be dependent how much it is regulated in India. For an unlisted entity is less regulated than a listed entity. Therefore, all investment in unlisted entity will be FDI. And if you see LLP, now LLP is a relatively new concept and it is still evolving in India. So whatever investment can come in the automatic route is can only come in the by way of LLP. So that's how it is, where you want to invest and who you are. So one has to see that whether who can invest in India. Any person can invest in India. So if a person is a person resident outside India, the investment can be made by, as the regulation says, that the person has to be resident outside India. Now, who is a person resident outside India? A person who is not resident in India. A person resident outside India can make investment in India. The only people that need a specific approval are if there are entities or person resident in Pakistan, Bangladesh, or China, or the other neighboring countries with which India shares the land border. Those people need the need the prior approval from the government before making investment in India. Otherwise, all the person resident outside India can make investment in India. Besides this, we have other investor classes also, like non-resident Indians, foreign venture capital investor, foreign portfolio investor, non-resident investors. So these are various classes. Like when we talk about the FVCI, so when we talk about foreign venture capital investor, so these are the entities which are registered with SEBI as foreign venture capital investor, and they can make the investment in specific sectors in India, and then they are giving not only the relaxations with the terms of the pricing guidelines or exit norms, but also in terms of the taxation. Now, non-resident Indians, obviously, as a country, we want to attract the investment from non-resident Indians. So there is like for the non-resident Indians. So non-resident Indians, so that is they are citizen of India, but they are not resident in India. So they are only not resident in India. However, they are citizens of India. So from then we invite, and as a country, the investment can come in any mode, can come on the basis of repatriation, on non-repatriable basis, in LLP, in listed company. So you name it, you just, as a non-resident Indian, one has to only think about the way in which the investment can be done. Sorry, not how the investment can be done. What is the purpose of the investment, and for how long do you want to be invested in India? Otherwise, the investment is allowed to be done in India in all the manner. In fact, for the sectors like which are prohibited sectors, the investment on non-repatriable basis can be made also in those sectors also, if it is in a non-resident Indians. Just that there are few things like agricultural land or farmland where the investment from NRIs is not allowed under the automatic route. Otherwise, the NRI investment can be made in everywhere. So this is the investment. The all type of investors can make investment in any type of the entity, be it the company, LLP, startup, investment vehicle, or depository receipt. So investment can come in by all type of people in various type of entities in India, and it depends the procedures and the regulations related to all these types are present in the NDI rules, which are the rules that are framed by the central government of India. If we want to summarize it it's right now the investment in India is very open, and it can come in the unincorporated manner or the incorporated entities. And in incorporated entities, it can come in the way of LLP, a startup company, depending on where the investment has should be there, and then it will depend on the sector in which the investment is thought to be brought in. So that's all I have for today, and I think I'll stop here, and we can take the questions.
Thank you, ma'am, for wonderful session on this strategy in India. And Anshul, do you have any doubt and you want to add on anything before
No, I
concluding
think
the
Sudhaji
session?
has explained it very beautifully, and I would not like to add something because everything has been covered very nicely.
Okay, okay. I think both the session has wonderfully covered on the entire topic which we have planned and discussed in detail. And both the eminent speaker, I would like to say thanks that in spite of this busy schedule that tomorrow is the last date of ITR filing, and still we are discussing on this topic of international tax. As there is no other query, then we would like to conclude. Uh, Anshul, do you want to say anything before concluding the session?
Yeah, I'll like to thank you, Sumitji, for organizing these sessions. As you said that during this time also when the last dates are there, and I also want to thank the participants who were there and listening to the session, because the session is successful only when the participants are there. And therefore I congratulate the CASA platform that they keep on organizing such wonderful sessions and webinars for the benefit of the members. And I also thank Sudhaji, my fellow former colleague and now fellow speaker. It's been such a long time that we interacted, and Sumitji provided us a chance to re-interact. So that's great. That's wonderful to reconnect with old friends.
Thank you, sir. And so that you want to say anything, including?
No, thank you, Sumitji, and Happy New Year to all your viewers. And I hope that this year brings more prosperity and health to everyone, all of us. And yes, thanks for providing knowledge to all of us. This is a very good platform that you have set up, and I can see that you are doing very good work. Wishing you good luck for your future webinars as well.
Thank you, madam. And I hope I can recall that you have delivered to earlier sessions also. And after counting all the sessions, we have organized more than 200 sessions in last 8 to 9 months with the help of each one of you for participating and giving deliberations, and to all participants where we have get the more than 1 lakh views every month. And thank you very participant, and wish you good luck. And I hope COVID-19 will go away in this year 2021. And with this positive note, we should move ahead in our profession. And thank you very much. And thank you to Anshulji and Sudhaji for giving wonderful and precious time with us. Thank you. Thank you,
Thank
madam.
you. Thank you. Thanks a lot. Bye.
Bye.